Well, there you have it. Finance Minister Enoch Godongwana has just delivered the national budget speech for 2026. And joining me now to unpack it all is Koketso Mano, Senior Economist at FNB, Mpho Mloboyane, Executive Chief Economist at Alex Forbes, and Martin Ackerman, Chief Economist at Citadel. Ladies, gents, thanks so much for your time today. Let's kick things off with your initial reaction to the budget. Koki, Minister Godongwana says we've reached a turning point in the management of public finances, with debt stabilizing, the deficit narrowing, and borrowing costs easing. Did this budget meet your expectations?
Certainly turning the corner then, Taoleng. I think it goes in line with what we've heard from the SONA, what we've been seeing in terms of structural reforms. So I think this budget really just reinforces that idea from a treasury point of view. We didn't see any surprises really from this budget. It is broadly as expected, a positive budget in the sense of what you said. We're seeing expenditures starting to narrow over the medium-term expenditure framework. Deficits are also narrowing. The primary surplus is maintained, which is going to be a key fiscal anchor until, a more official one is announced. Yes. And then importantly, the 2025-2026 fiscal year is broadly seen as the trough in terms of, some of these matrices, and also the peak when you look at debt to GDP. So relatively very good in terms of our expectations.
And we'll circle back to the fiscal anchor. Just going around the panel, getting your expectations then, Martin. I mean, staying with the broader tone, it's being delivered against, optimism, where we've seen South Africa coming off the FATF grey list, a credit upgrade, as well as, record low bond yields. How would you characterize the political and economic mood underpinning this budget? I must say, politically, it's been a bit boring, but hey, we take that after what happened last year. Martin?
I fully agree. I think if we think about last year this time, bond yields were 11%. So the market told us a very different story. Today it's 8%. So in there, that is actually what played out. So you're 100% right. I think more stable political environment, government of national unity is on a better footing compared to last year this time. We had, thanks to President Trump, believe it or not, but the gold and the platinum rally is large as a result of some of his policies. We being a major exporter, we had that tailwind, confidence getting better with us having some positive outlooks and getting off the grey list. And that's why today even, we expected this positive budget, more rosy compared to last year this time. But the market didn't really move a lot. The rand and the bonds are quite stable because, like I say, we saw this movie coming. But it's still a very good movie, and we're very happy about the outcome.
And let's get your sentiments around that, Mpho. I was about to ask you about the market movements, as Martin has highlighted, and not much movement when looking at the rand as well as the JSE, as we did expect a rosier picture, so that was already priced in.
Yes, I think a lot of the good news budget had already been priced in, ahead of expectations. We really were not expecting any major surprises, and there weren't, right? There weren't any major surprises. I think the macroeconomic backdrop, to just start with that, was quite supportive of this good news budget. Growth had continued to improve. As Martin also pointed out, the rise in platinum and gold prices, that has helped with the revenue story, right? So overall, most of the details that we are seeing in this budget suggest that there's no major surprises. But if anything, there's actually potential upside, right? Yeah. But importantly, the bottom line is that it reaffirms government's commitment to fiscal sustainability, and also charts a better growth trajectory when we look at the breakdown of expenditure, which we can get to into a lot more details. But, pretty much in line with market expectations, continuing to improve fiscal ratios, and no nasty surprises like last year.
And talk to me further about that potential upside, Mpho. We got that juicy revenue overrun of about 21.3 billion rands, which was above expectations or projections, driven by VAT, corporate income tax, and stronger compliance from SARS. We touched on the commodities windfall that we are seeing. How much of this is structural improvement versus cyclical support on the back, of course, of the commodities boom, Mpho?
Yeah, so I think some of it is largely that commodities boom. I think National Treasury has also been quite conservative in its assumptions, right? Realizing that the rise in commodity prices could turn, overnight. But largely coming from better CIT collections. But also we've seen an improvement in VAT collections, right, which also speaks to the consumer,
yes,
that the SA consumer has been doing better. Consumption is slightly higher than what, or rather consumption in 2025 was higher than what it was in 2024. And that has also contributed to better VAT collections. And in addition to that, VAT refunds have also been lower, with SARS also increasing its efficiency and clamping down on leakages as well. So that has been quite supportive of this improvement in revenue collections. Yeah.
Kogi,
what has also been quite interesting, sorry, to just add lastly, what is also positive about the revenue outlook is that you'd recall last year that National Treasury had that 20 billion in tax revenues, right? Which it said it will give details in terms of what those tax measures are going to be. But given the, that sustained improvement in the revenue outlook, they said that, no, we don't have to put that on the table. Let's suspend that. Personal income brackets have also now been adjusted for inflation. So, just really continue to point to this, both a commodities boom, but also reflective of that gradual improvement in the macroeconomic environment.
Let's get your take around, the revenue collection that we've been seeing, Kogi. I mean, Mpho mentioning there that the consumer really not necessarily under pressure and also more or relief coming through as that bracket creep has been taken away.
Yeah, and I think, when you look at the macros, right, and even the retail sales data, you would assume that the consumer is not necessarily that much under pressure. But I think the understanding here, especially for your medium to lower end consumer, there's still a lot of vulnerability, right? You still have monetary policy relatively restrictive. Inflation for certain categories is still not in line with that 3%. So I think there's an understanding that those sectors or those segments of the household spectrum still require some sort of support, and it should come across with this, removal of bracket creep, as we would call it, to allow for these adjustments to be made. And I guess also going forward, the minister did mention that it is to make sure that you sort of build resilience into the recovery. We know that the household sector has been driving the recovery in the economy. We know that they probably contributed positively in the fourth quarter as well. So you just want to embed that continued recovery that has been household sector led.
So household spending continuing to fuel growth, but we are moving into a more investment-like drive to sort of fuel growth. Martin, I want us to look at the debt picture, right? Sticking point going into this year's budget was debt and debt servicing costs. Treasury now expects debt to stabilize at 78.9% to GDP before declining. And we've been told before that debt has peaked. Is this finally the turning point, or is the debt path still vulnerable?
No, I think, if the commodity cycle turns very sharply, then, that will put the debt path under pressure. And that is why exactly, Mpho said that they're making very conservative or realistic assumptions in terms of commodity prices going forward. We need to do that. We know as a commodity exporter, we can't bank on this to continue forever. So the topping out and the turning around, I do think that given this framework, it is possible. I always spoke about the debt wave because government just keep on riding this wave, and every year the numbers are the same or slightly higher. Minister Tito Mboweni at the time warned that, we're facing a debt spiral. So I think we're not on the cliff anymore. The environment is providing us to do the right things and to actually get more sustainable improvement. And then, just back to the interest rates, there's a huge difference in paying 11% on your debt versus 8%. And if we continue with this positive outlook, hopefully sometime getting an upgrade again to investment grade, all of that reduces the risk premium for the country, and that makes our debt management much more sustainable. So I do think, this is hopefully the start of a more sustainable turning point.
Martin, quickly before we head into a break, you mentioned the rating agencies there, and you said that this provides a rosier outlook when it comes to upgrades. Do you expect an upgrade, whether it's in terms of the outlook, whether in terms of a credit coming from Fitch as well as Moody's?
Yeah, I think, they typically stay on the cautious side. They will take into consideration that a lot of the improvement is external factors like the commodities that we spoke about.
Yeah.
Our actual growth number is still, even the numbers today getting to maybe 2% at the end of the fiscal framework. We need to do better than that to actually have more sustainable revenue in terms of collecting tax on an economic growth basis. So, if we get a upgrade to investment grade, we will be one of the countries that's seen the quickest turnaround and upgrade. So I think it's early days in terms of that, but in terms of a positive outlook, this budget is definitely allowing for that to take place.
All right, so still on the road to recovery. And Paul, maybe let's get your assessment of the credibility of this debt trajectory and the efforts being made to bring it down.
Yeah, so I think on my end, the one thing I do worry about is that we have this, slight kink in the debt to GDP trajectory. One would have expected that the underlying macroeconomics actually benefits national treasury.
Yeah.
And I was actually expecting that the debt to GDP ratio would be downwardly revised, right? So firstly, yes, we have inflation is lower than what was previously forecast. But if you also think about it, we have had an increase in export commodity prices. So the GDP deflator, essentially, it's a bit technical, the GDP deflator should have been better. So there should have been some offsets. And in addition to that, revenue is also a lot better.
Yeah.
But instead, what National Treasury decided to do was to increase issuance, or rather increase the cash holdings a lot more aggressively to try and deal with the upcoming debt redemptions, which are much larger. So that meant that we see this a slight uptick in the debt to GDP ratio, but then it also comes down in the outer years, right? So, it's slight deterioration if you think about it in the current fiscal year, but next year and the year thereafter, it is better than what was previously anticipated. So for me, I think I'm not too sure how rating agencies will view that. But overall, it was a good news budget. And, the thing is with some of these underlying data as well as variables, they do change, right? So for instance, next week, when STSA publishes the GDP data, they will be rebasing the GDP numbers. Now, GDP could be, the size of GDP could be a lot larger than what these numbers are actually showing. Nominal GDP could also be a lot larger. So these ratios could also change. And we may still end up with a much better looking debt to GDP trajectory. But I think the bottom line here is that National Treasury is holding the line.
Okay.
They are being quite conservative on, revenue projections. They continue to focus on reconfiguring government expenditure to investment, more investment expenditure, which should be helpful in terms of achieving that sustained improvement in the GDP trajectory. So, overall, I think when you look at the underlying factors in terms of what's driving the debt to GDP trajectory, it's still positive. And I think Treasury is doing enough, certainly, to preserve fiscal sustainability.
And, that brings me to my next question around spending then, Koki. Government plans to spend 2.67 trillion rands, with over 60% going to social wage, while also identifying 12 billion rands in savings. How do you assess that balance between cutting expenditure and also protecting key sectors? How much more can realistically be trimmed without harming service delivery? So those trade-offs at play.
In our FNB Economics Weekly last week, we did publish the whole ordeal around spending priorities and the fact that government has a fine balancing act to make. And the argument that we made there is that, yes, as much as you may still want to improve the operating environment for businesses, so you want to, tackle the infrastructure issue, so that's definitely a spending priority, while bringing in the private sector. But also, you can't run away from the vulnerabilities of our society, right? The high inequality, the high unemployment will still require you to offer some sort of social protection. And we see that balancing act coming through in this budget as well, where they say, okay, well, we do need to continue spending on the social wage, but at the same time, we're going to try and make sure that inefficiencies that currently exist in government are narrowed, right? So how do you improve spending efficiency going forward, making sure that budgets are not just growing by inflation, but you can prove the importance of such budget spending going forward. And I think the other thing that government is trying to do is to support businesses, because there's a general understanding that yes, we'll have these reforms, yes, we'll see growth improving over the medium term, but it'll take time for you to see an improvement in some of these socioeconomic issues. So in the meantime, make sure that people that are operating in the fringes of formal employment are still participating in some way in this economy, and also embed their growth over the longer term. So those are small businesses, the informal market. So I think that balancing act is coming through quite neatly in this budget.
And we did see him put money towards the small business department there. As you know, small businesses are considered the lifeline of this economy. Martin, with everything that Koki has highlighted there, that fine balancing act when it comes to spending priorities, do you see this budget, the approach to this budget coming through with a meaningful shift toward funding for growth?
Yeah, I think, the focus on the infrastructure development, the focus on the private participation, we saw the benefit that changing regulations on electricity supply had in terms of pulling in the private sector, crowding in the private sector. So there is definitely those kind of, they mentioned 63 projects that's currently in the pipeline. So this budget definitely provides further evidence that we're moving down the right path. That's why I also said when I started that, keeping the government of national unity in this kind of position, that's the only way we're going to be able to deliver and execute on the policy reform that is in the pipeline. But the focus should very much be on infrastructure, but not only that, fixed capital formation. They've mentioned the numbers, we're still not seeing enough in that space. We're sitting at 14% of GDP. The NDP target is 30%. China is running at 25%. We used to be close to 20%. And until we see further investments, we need to start investing back into the country to build and fix our capacity. Only then we will see sustainable growth. There's no way we're going to see growth if we don't get that fixed investment into the pipeline.
And your views then, Paul, around that growth trajectory story. Martin mentioning that we need more investment to see more sustainable growth.
Yeah, so the current projections, and pretty much in line with the market consensus, growth improves to around 1.5%, 1.6% this year, and increasing further to around 2% by 2028. But that's still quite muted. When we look back to when GDP growth was around your 5% level, investment as a percentage of GDP was around 21%. So that, just gives you an idea in terms of how much that investment needs to increase by if we want to go back to 5% growth levels. And, another key important point here is that while growth is improving and we are now credibly talking about 2% growth, it remains insufficient to make a meaningful dent on the high unemployment rate, right? So we, should at least be striving strongly for 2.5% and then 3%. And then we, could see sight of 5%.
Listen, I can't wait for better days where I can say that SA growth is up 5%, 6%, All right, I'm going to go around the panel before we wrap up. Our consensus here is that it was a good budget, no surprises. But I'd like to get maybe your rating out of 10. What would you give it, Koki?
I would give it a good 8 out of 10.
Okay.
I think I'm
I think
it's an A. It's definitely an A. But most importantly, I think from the SONA and continued government engagement, we are turning the corner. We haven't turned the corner, so there's no space for complacency. A lot more still has to be done. So maybe that's where my 20% goes.
And the key phrase there is turning the corner. Martin, what would you rate it?
Yeah, I agree. It's definitely an A. We could have seen a populist turn the fact that there's some money on the table.
Yes.
And that will just throw away years of hard work trying to consolidate on the fiscal side. So sticking to their guns, so to speak, in terms of delivering what we need to deliver for sustainability, I think, that gives it a high rating.
All right, Mpho, wrap it up for us. What would you rate it out of 10?
Yeah. I would, also give it a Koki stole my number, I must say. When you asked that question, I had 8 in mind. So, I'd also go with an 8 out of 10. So still an A. I think this budget does enough to secure fiscal sustainability and chart a much stronger path going forward. Let's hope that the commodity cycle will remain in our favor.
Yeah, let's leave it there. Road to recovery. Ladies, gent, thank you so much for your time and unpacking that budget with us this afternoon. Thanks to my guests, Koketso Mano, Senior Economist at FNB, Mpho Mlopoyane, Executive Chief Economist at Alex Forbes, and Martin Ackerman, Chief Economist at Citadel.